of the Hutchins Center on Fiscal. I welcome you to the event today to celebrate the publication of Eshwar Prasad's new book, The Future of Money, with this incredibly artistic cover that we've been discussing and approving of. Eshwar is a colleague of mine at Brookings in the Global Economy and Development Program, and also a professor of trade policy and economics at Cornell University. And I'm joined also this morning by Glenn Hutchins, who's co-chair of Brookings Board, the man who put Hutchins in the Hutchins Center, and who has been interested in cryptocurrency and blockchain for several years, well before it became a fad. And Glenn and I discussed the other day, how do I explain his conflicts of interest? And the answer is, whatever he talks about today, he has a conflict of interest in because he's an investor in this space. But I invited him because he knows a lot about this, and I thought it would be a great combination to have an academic and policy person like Eshwar talking about the really interesting features of his book, and Glenn, who really has his hands in this marketplace. Following our conversation, we'll be joined by a number of experts in this field in a panel moderated by Gillian Tett, who is from the Financial Times. Then we'll think there much more about particularly about the public policy issues. And if you have questions that you'd like to ask, you can use the Slido software, sli.do, hashtag future of money, and we'll keep an eye on that feed to see if you have anything to ask. This is on the record and being recorded. And I wanted to start by reading the first paragraph of the conclusion of Eshwar's book, which I think puts it in perspective. Eshwar writes, the era of cash is drawing to an end, and that of central bank digital currencies has begun. Money, banking, and finance are on the verge of transformation. Physical money is slated to become a relic, with digital payment systems becoming the norm around the world. Banking is going to change as other forms of financial intermediation gain prominence. Much of the world's population will gain access to at least basic financial services, improving lines and economic forecasts. In some respects, the new era will look dramatically different. In others, though, things will remain much the same. So Eshwar, with that as background, can you give us a snapshot of what you think the future of money will be like if we were having this conversation, saying a decade or two in the future? Will I no longer have a leather wallet with dollar bills in it? Will we all be buying coffee at Starbucks with Bitcoin? What's your forecast about what the world will look like and what will be different and what will be the same?
Thank you for that introduction, David. I should begin by saying that with deep regret, I have no conflicts of interest because I did not have the foresight when I launched my analysis of digital currencies to actually invest in Bitcoin. So sadly, at the end of this, I have a book, but no Bitcoin. We are at a very interesting juncture in terms of the evolution of money. Certainly, I think the likelihood that we will have cash in our physical wallets in the years to come is going to diminish by the day, and it's already diminished very substantially in some very advanced economies such as Sweden, but also in many of the developing and emerging market economies. So change is clearly at hand with digital payments of various forms becoming the norm around the world. But if we step back a little bit and think about the broader arc of history here, there are more fundamental changes at play. Many centuries ago, when paper currency was created, there was essentially creation of currency by private individuals, by private merchants, and eventually private currencies, which were in competition, gave way to fiat currencies issued by central banks, which essentially drove out private currencies because they could not compete with government-backed money. Now we are coming to a point where, in fact, private currencies may once again compete with government-issued or fiat currencies. And these new forms of money are taking two forms. One is decentralized cryptocurrencies, such as Bitcoin, which have certainly gotten a lot of attention, and also more centralized cryptocurrencies, which in some sense draw their value from being backed by fiat currencies. These are the so-called stable coins, with even Facebook planning to issue one of its own. But what this portends, in my view, is really a new era of competition that could ultimately benefit both consumers and businesses, but it's going to be in the form of digital payments of various sorts. And this is going to be good, not just for consumers and businesses within economies, but cross-border payments where there are a lot of frictions that affect, say, economic migrants sending money back home, exporters and importers. All of these barriers are going to become much less significant impediments to the flow of finance. I think we're also going to see a bifurcation of the roles of money. Now, the traditional way of thinking about the roles of money is as a unit of account, a medium of exchange. That is something that can be used for transacting and also as a store of value. I think with digital payments of a variety of sorts, we're going to see decentralized as well as centralized cryptocurrencies and other digital payments essentially taking over some of the function of central bank issued money, especially in the form of payments. But my abiding view is that ultimately what is essential for a store of value is not just the ability to conduct transactions quickly and efficiently and cheaply, but also an institutional framework that creates that trust. Now, the promise of Bitcoin was that you could replace trust in a government or in a financial institution with a form of public decentralized consensus. And that has certainly had some traction. But I think over the long run, what we will see is that the viable stores of value are really still going to be the fiat currencies. So this bifurcation, I think, will have certain important implications. But stepping back even further, I think what is interesting is that there are new financial technologies that are really going to have a transformative effect, not just in terms of money, but in terms of broader aspects of finance, with direct ways of connecting savers and borrowers becoming more important. And these are going to have huge benefits. I think a lot more people will be included in the financial system. They will have easy access to a digital payment systems without necessarily having to have a debit or credit card or a bank account. You will have easier access to a portal for basic banking products and services, for managing risk, for getting credit, for making savings, and so on. And this is going to affect, at some level, even the structure of financial markets. So even what we know about central banking, how the actions of central banks affect the economic activity could be affected not just by changes in the nature of money, but also by changes in the structure of financial markets and institutions. So I think in principle, this is a wonderful world that is coming out there, but it's not going to be without risks. I think after the global financial crisis, the somewhat hubristic notion that financial engineering could basically dissipate risks in the system is something we have learned might be a bit of a mirage. So there are going to be new risks, but also new opportunities. And I think governments are going to continue playing a very important role in making sure that we can get the right sort of benefits from these decentralized payment systems and decentralized finance more broadly. The opportunities are great, but we're going to have some stumbles on the way ahead.
Let me ask, I want to make sure I understand, define a couple of terms for me. When you refer to private, Bitcoin being private, you mean non-government, right? It's public in the sense that there is this decentralized ledger out there, the blockchain. Is that correct?
That is correct. When I refer to private here, I refer to the issuer, which is not a government entity or a central bank.
And when we hear talk of the Federal Reserve or in the Bank of Finland, as we'll hear later, the e-krona, they're issuing a central bank digital currency that's much like a dollar, but it's digital. Does that involve the blockchain as well, the underlying technology, or is that not part of the blockchain empire?
It could. So the blockchain is the technology underlying Bitcoin, and it's proven to have very many benefits, not just in facilitating payments, but essentially as an architecture for a different financial ecosystem. But the problem with the blockchain, especially the Bitcoin version of the blockchain, is that it's not very easily scalable in terms of managing a lot of transactions, especially microtransactions. Now, as David has pointed out, central bank digital currencies, CBDCs, very much in the air. The Swedish Riksbank, and we'll hear about this some more as we go along from the Deputy Governor of the Riksbank, the Chinese Central Bank, and many others are already running trials of CBDCs, which would essentially replace or be a complement to the existing physical versions of their currencies. So we'd have a digital version of the yuan in addition to the physical version of the yuan.
I see. Glenn, I was looking up an event we had in 2016, which was quite a while ago, 5 years ago. And I remember talking to you about that event. It must have been even before that. And you said that you thought there was a chance, maybe only 5 to 10% chance, that the blockchain, this distributed ledger, could be as important an innovation as the protocols that allowed us to use the internet with browsers and apps and all that. And I just wondered whether the world has evolved as you anticipated, or faster or slower in that direction.
So thank you, David. I'll answer that question. I want to say a couple of things. First, I want to congratulate S4 on a brilliant and very timely book. Well done. Bravo. And I want to correct David. The most important thing I did was put the Wessel in the Hutchins Center, not the Hutchins.
Thank you.
So let me take a step back, and I think to have these conversations coherently, I think we need to make a fundamental distinction between a digital currency and a cryptocurrency. People use them interchangeably, and they're not, in my view. A digital currency is, in my view, simply the digitization of an analog object. It's not unlike the Wall Street Journal analog paper being converted into a website. It's a very simple, kind of straightforward thing. And as a consequence of which, most of the digital currencies we're talking about that the central banks would offer are digital currencies, are not cryptocurrencies. A cryptocurrency is something very different and is a fundamental innovation. And a crypto, I'm going to spend a few seconds on this just to level set everybody. The cryptocurrency came from the sort of solution started with Bitcoin. By the way, it has evolved way beyond Bitcoin now in the entrepreneurial world to Ethereum, which is about smart contracts on non-fungible token for about a host of applications. We can come back to that later. But the Bitcoin solution was about the problem of trust-free exchange. It combined network theory, which is about promoting efficiency, game theory, which is about creating incentives, using incentives, and cryptography, which is about security, into one solution, which involves a protocol, which is the network, a token, which is the incentive system, and a blockchain, which provides security as well as accounting. Any understanding of cryptocurrencies, absent those understanding those three, are inextricable as part of the solution. They cannot be presented and used separately in any sort of innovative way. Doesn't understand what a cryptocurrency is. Two other points I would make. One is the stable coin is most effectively used right now, and I think its goal is useful be as a bridge between digital currencies or fiat currencies and cryptocurrency solutions. Or maybe it's better understood as an entry and exit ramp. And then secondly, let's talk about blockchains and tokens. The three elements, protocol, blockchain, and a token, are inextricably linked. Like an internal combustion engine has a battery, a powertrain, and a set of pistons. And you can't just look at a battery or a powertrain or the pistons and say one of those things makes the cargo. They work together to make the cargo. The people who look at blockchain independent of a cryptography solution, just looking at a fancy database. A private blockchain associated with one solution is essentially like the intranet. The magic of the blockchains is when they all get connected together in the World Wide Web of blockchains, like intranets were connected to the World Wide Web to becoming the internet. So blockchain is not interesting as innovation independent of a token and a protocol. The token itself is catnip for journalists. They like to talk about what its price is and how it trades, and it's on CNBC and all that kind of stuff. But again, the value of the tokens are primarily in their use case as they attach to cryptocurrency solutions. So digital currency, cryptocurrency, completely different. Looking at blockchains or tokens independent of protocols and independent of all three working inextricably, fails to understand the nature of innovation. The last point I would make, and I'll stop here, is The most conventional application of Bitcoin that seemed like the real world that people could understand was payments. But what it really is a new form of computing, decentralized computing. And it's one of the new paradigms of computing, one of the fundamental paradigms of computing. We've gone from, in my investing lifetime, from mainframes to minis to micros to distributed computing to cloud computing and the mobile computing. Those have each created massive changes in creation and destruction of value. Decentralized computing is a new computing paradigm. The cryptocurrency solutions are best thought of as a decentralized computing that create all sorts of opportunities to create exchanges of value with value defined very, very broadly. We can come back to that if you like.
Okay. Lashwar, let me ask you two questions. One is, do you look at the world the way Glenn does, or do you see a different framework for thinking about this stuff?
So it took me about 2 40-page chapters to go over what Glenn so very succinctly described. And he's right in the fundamental point that the blockchain technology is really a marvel in many ways. And we very much focused on the fact that it hasn't worked that well in terms of scaling up payment systems. But what it has spawned is a financial ecosystem that is going to be capable of a lot more. The promise of decentralized finance, I think, is really quite remarkable. And there are already products out there that bridge many missing financial markets that can create real financial value. But having said that, one point I should make to complement what Glenn said is that the notion that these decentralized products are ultimately going to also be very effective at self-governing is one thing that I worry a little bit about. There are certain technological issues that still need to be sorted through. But in addition, there are certain vulnerabilities that we may not even know about at this stage that I think should all give us some pause before we too quickly move into a world where decentralized finance takes over. I think there is still going to be a very important role for regulators in terms of making sure that these risks can be managed. But I think Glenn is very correct in terms of pointing out the enormous promise that blockchain has in terms of democratizing finance.
So what is the biggest risk that you worry about as we go forward here?
So let me give you one example. It turns out that you can take a variety of specific financial products and combine them like financial Legos into a much more composite product that allows you to get access to, for instance, large amounts of credit for very short periods of time. This allows for arbitrage possibilities across markets and ultimately makes financial markets work somewhat more efficiently. You could even in principle plug regulatory modules into these financial products, which in principle should make them safer. One of the concerns I have, however, is that the more of these modules you build in, the sort of attack surface for malicious actors increases. And since this is a self-governing community, it's not obvious if we're going to have solutions developing in real time that can fix these vulnerabilities. One of my Cornell colleagues, Ari Jewels, in fact, pointed out that there was one example where he and his colleagues found a flaw where certain bots, automated computer algorithms, could basically front run certain financial markets and create profit-seeking opportunities. And what they did, of course, because there was nobody to report this problem to, they publicized it in the hope that people would protect themselves. Instead, it generated a bot-making industry that exploited this opportunity before ultimately the community came by and fixed it. So certainly the notion that a lot of this code is open source, that things can be fixed, has a lot of appeal. And I think ultimately it's going to work out to everyone's benefit. But in the short run, I think there are some risks we need to keep our eyes on.
So Glenn, it seems to me that in general, what we want from regulation in this area is protection against abuse, people being ripped off, financial instability on the one hand, but we want to also make sure that regulation doesn't become a damper on innovation, especially given the interest that vested interests will have in preventing some of the democratization of finance that this technology offers. So when you think about what's the right framework for regulation of cryptocurrencies and fintech in general, how do you think about what the principles should be?
Good question. So, and I want to come back to a few other things that's what I said, but on the regulatory point, it's my view, it's very, very important for this industry for it to operate inside a regulatory a framework that allows it to define what's good practice and what bad practice, and would allow it, in my view, to thrive, just like any other financial services ecosystem, which I've invested over the last 25 years. It's very, very important. And I've advocated that. And the 2016 meeting you talked about was one where we brought together a bunch of regulators, you'll recall, to begin to understand this space so that they could begin to craft smart regulation. Give you one example of kind of groping toward a solution. In the bipartisan infrastructure bill, there's a pay for, people on this call I'm sure know what pay fors are. That's associated with better tax compliance coming from cryptocurrencies, market makers, et cetera. The industry is, all the industry leaders are completely supportive of better tax compliance or appropriate tax compliance. The problem is that the first draft of legislation brought in software developers and miners and validators who had no access to the information necessary to make the reporting. They were just infrastructure developers or people who were licensing software to people who were doing the cryptocurrency transactions. The regulators knew so little about the space that they actually were imposing reporting requirements on people who did not have the access necessary to make the reports. That's a very good example of and the industry was able to rally and kind of stop that. And we've been able to sensitize the regulators to kind of how to make distinctions between people who have the information, people who are just service or technology providers. But that's an example of a lack of understanding at the regulatory level that can actually impede innovation as opposed to create the circumstances under which innovation can flourish because you've got a regulatory framework that works. The other thing I would say, I think Eswar made a very good point about short-term problems versus long-term solutions. I would say that the regulators and commentators tend to focus on short-term solutions as short-term problems and impediments. Entrepreneurs tend to focus on them as opportunities. And so for every impediment that there is in the space, there's a company being formed to address that. So every impediment is, in my view, an investment opportunity. And we can go through it. But the main, I think the best analogy for this decentralized computing system that Eswar was talking about, where there's some issues around communities adopting practices that are constructive in the near term. The best example of this would be when we started introducing open source software, particularly Linux, in 20 years ago. And the producers of the closed system, Unix and SQL, the Microsoft, all said it was going to be much less robust, much less secure. And now we go fast forward 20 years and it's the standard. And the ones that are promoted by its closed sources as opposed to open source actually proved to be less secure and more expensive to use. So I think we have a history, we have a very good analogy in the technology industry of kind of what you might call open source actually outperforming closed source kind of things. And the last point I make about regulation is, and you alluded to this, David, is regulation can also be used as a barrier to entry by the regulated companies. And every time I see a CEO of a major financial services company denouncing Bitcoin as a fraud, it strikes me that that's just an attempt to keep a regulatory moat kind of around their organization. In the world of moving money around the world, so in the world of trading in stocks, in the last 20 years, the price of trading in stocks has been reduced by 99.5%. It's literally 0.5% of what it was 20 years ago. The world of moving money around the world, credit card payments, remittances, foreign exchange transactions, payday loans, et cetera, has gone up during that same time period. And the companies that are in those segments want desperately to keep those prices high, and they will use regulatory barriers to entry and obfuscation to protect themselves. And we should just be alert to that.
Thank you. Eswar, you speak a lot in the book about central bank digital currencies. That is, that the Federal Reserve might someday do what the Riksbank is doing in Sweden. And I wonder if you could talk a little bit about whether you think the Fed should do a central bank digital currency and what are the pros and cons. Clearly, the Fed doesn't want to be a pioneer here. They want to let someone else experiment first, and that probably makes sense given the reserve status of the dollar. But is it a good idea to have a central bank digital currency in the United States, and what difference would it make?
So central bank digital currency at some level, as Glenn mentioned, is basically just a digitization of the dollar bills in your wallet. And that's the way the world is going. I mean, most of us now pay for our purchases of coffee using debit or credit card or Apple Pay. But the key thing about a digital dollar is that it would make this very low-cost digital payment system available in a much more democratic fashion, even to the unbanked and underbanked. So long as you have a cell phone, you might have easy access to a central bank digital wallet that gives you a payment system that is very low cost, that is very efficient, without all the other financial accoutrement. So that's certainly a good thing. In addition, from the government's point of view, it certainly makes sense to have its digital currency be in a form that is not easily usable for nefarious activities such as terrorism financing or money laundering. It brings a lot more economic activity out of the shadows into the formal tax net, which some of us might consider a good thing, a libertarian might not. In addition, it expands the policy toolkit of the central bank. Now, one wouldn't want to think about this as a normal policy tool, but certainly with a central bank digital currency account, and if cash withered away almost organically because of these digital payments, you could, in principle, in very dire economic circumstances, have a negative nominal interest rate. Cash is a zero nominal interest rate, but if you could reduce the balances in a CBDC account, that would, in principle, encourage consumers to go out and spend and businesses to invest. You could also do something like the coronavirus stimulus payments directly through infusions of cash into the central bank accounts. But this is not without costs. I mean, you touched upon this. There is a risk that a very low-cost government mandated payment system could end up squelching private sector innovation, and we don't quite want that to happen. Having a CBDC account and running fiscal policy through that does have certain risks for the central bank if it starts being seen as an agent of government policy. And most importantly, if CBDC accounts were seen as safer than commercial bank accounts, even if the CBDC accounts did not pay a positive rate of interest, you could have deposits moving from the commercial banking system to the central bank, which then starts becoming more responsible for allocating credit. Nobody, including a central bank, wants that to happen. Plus, we would lose privacy in our transactions. So there is a fine balance, but these risks can be managed. And the Riksbank's trials, the Chinese central bank's trials are beginning to show us that there are ways to manage this balance. You can, in fact, have versions of this CBDC that allow you to undertake at least low value transactions without completely compromising privacy. There are ways of limiting the amounts of money you can put in CBDC accounts such that you don't lose the commercial bank's importance in the financial system. So I think we are moving towards a world where CBDCs are really the wave of the future. And I think we'll come to a policy and design scenario where ultimately many of these risks can be managed. But I think we're going to have a conversation, David, not just about the technical economic aspects, but also about the social aspects, because ultimately anything digital is going to leave a digital trace. And whether we want to live in a world where every payment ultimately is going to be visible to a payments provider of the private sector or the government is something we need to have as a society.
I mean, I think there are two things you mentioned there I just want to tease out. One is, so I think there's the popular view that Bitcoin is a way for illicit transactions, that people are somehow able to hide themselves behind the anonymity of Bitcoin. But you make a really good point there that, of course, if I have a $100 bill and I give it to some drug dealer, that there's no record of that. He has my $100 bill. But with digital, any kind of Bitcoin thing, there's going to be a ledger. And as we've seen, there are ways to trace that. So I think that's interesting. People sometimes, I think, confuse that. After all, we know who's using $100 bills and 500 euro notes, and it's not the average person buying coffee at Starbucks. But secondly, I'm not sure it's a great marketing tool if I wanted to convince Americans that we should have central bank digital currency, that it's going to allow the Federal Reserve to impose negative interest rates on us. Seems to me the political reaction to that could strangle this baby in the crib.
You're absolutely right, David. I think it's important to make the point that that is an extreme policy tool for extreme circumstances. And I think every central bank that is moving forward with CBDC is making the point very clearly that this is a complement to cash, and it will have cash-like features, zero interest bearing, and that it will have just a digital representation of cash. What I'm talking about as an academic is the possibilities, and you're absolutely right that once we start talking about these possibilities, which may be reserved for particularly perilous circumstances that could make it difficult to get CBDCs off the ground. So perhaps we should just talk about the more mundane possibilities. On Bitcoin, David, the distinction you make is a very important one. It turns out that one of the remarkable features of Bitcoin's blockchain is at one level the radical transparency, because every transaction, the amounts and the digital identities of the trading parties are posted on a public ledger that anybody with a computer has access to, because it's posted on multiple computers. But in principle, it does provide pseudonymity. You need to use only your digital identities. It turns out that promise of pseudonymity is difficult to maintain when the digital world meets the real world, when you actually have to transfer the money into a real bank account or buy something real with it. There are new cryptocurrencies that are offering more promises of anonymity, but I don't think that's going to be the key defining feature of the cryptocurrencies to come.
Glenn, what should I make of this Facebook move, they're now called the DM, their currency? Is this a big deal, a little deal? Just Facebook to get in on a party, or what?
It's a little, I'll answer that question. I do want to respond to a couple of things, or highlight a couple of things that Prasad said, which is I'm not. I said, let's put it this way. You said I'm a walking, talking conflict of interest because I've invested in everything that I'm talking about, right?
I was quoting you. I want to be clear. I didn't make that.
No, you're right. But I want to elaborate on that, which is I'm not an investor in DM.
Okay.
Let's put it that way. I think that's my answer to that question. So, but on two things Eswar said, I want to put a little point of emphasis on cash. Only 5% of cash, $100 bills are in circulation, right? The other 95% are underground. It is the US $100 bill is the primary means by which the bad guys around the world exchange and store value. We should understand that there's a huge cash problem that needs to be addressed. And I think the digital, even though there's some serious privacy issues, the digital currency is a way of doing that. Michael Groniger is going to be on your panel next. Full disclosure, I have an investment in his company too. But he has the best tools for the surveillance of blockchains around the world and the best information about illicit transactions. He'll tell you, but the worst year, if I have it right, the worst year for Bitcoin, just less than 2% of Bitcoin transactions were for illicit purposes versus 80 to 90% of US $100 bills. And on average, it's usually about 1%. The notion that Bitcoin is used primarily for illicit transactions is just fundamentally wrong. It needs to be disposed of by people who keep saying that. And Michael has the data to show you that. The other thing I would say is that with respect to innovation, I am deeply skeptical about the capacity of government agencies to be innovative. And it took U.S. Central Bank 5 years to adopt, at least 5 years to adopt cloud technologies after industry had broadly adopted them. And the notion that a government agency is going to be on the forefront of innovating in this space strikes me as highly, highly unlikely. Though I think his ideas are good from an academic perspective, and I agree with them. And he said he stated, I think, very clearly what he's trying to accomplish, which is to highlight what can be done in the practical world in which I live. I'm deeply skeptical that it will be done.
Neshwar, finally, could you just tell us what you think about the experiment in El Salvador, where they had largely dollarized their economy to begin with, and now they're trying to make Bitcoin a medium of exchange with some hiccups?
I think one point that experiment has revealed is that ultimately there is no substitute for good government policies. If you try to import a foreign currency, decentralized or otherwise, it's not going to work very well. And Bitcoin, I think, as a medium of exchange has certainly not lived up to its promise. But connecting this with the question you raised to Glenn, David, I think while a major currency such as the dollar, perhaps the Chinese yuan, the British pound sterling, the euro, these won't be challenged by private decentralized currencies or even by stable coins such as Facebook's Diem. There is a real existential threat for small economies or economies with central banks that are not very credible, that the availability of digital versions of the dollar or the renminbi or other such currencies around the world, which is not on the cards quite yet, but could happen soon, or even the availability of a cryptocurrency issued by a major corporation with a wide reach such as Facebook could very quickly displace some of these currencies. So there is a lot going to happen, not just at the domestic level, but even in terms of the international monetary system.
Thank you. Okay, with that, I want to thank both Glenn and Ishwar. Ishwar will be back later at the end of the program. Really interesting. I told some friends that I was doing this event, and they said, hope that you'll ask questions so that I can understand the significance of what this all is. So now we're going to give us a moment, and we're going to switch to a panel that my friend Jillian Tett from the Financial Times will moderate. And again, if you have questions, Slido, sli.do, hashtag Future of Money or Twitter Future of Money, and we'll keep an eye out for those. So Jillian, over to you.
Oops, Daisy. Fantastic. Right, can you all see me and hear me? Fantastic. Okay, I think we've got everyone here. Well, listen, I found that debate fascinating because if nothing else, it helped to demystify and clarify a lot of the concepts. I mean, one of the big problems as a journalist writing about this is that, in a sense, you need to have, a skill set which involves not just good economic analysis, but you need to have good technical analysis. You need to understand cryptography, and you also need to understand behavioral science, sociology, dare I say it, anthropology, speaking as a former anthropologist. You need to understand all of those fields to understand what's going on. And very few people have all of those three separate skill sets. So thank you for clarifying so much, and thank you for the great book as well. And we have a group of practitioners who are confronting these issues in a very direct day-to-day way, not just in terms of theoretical analysis, but actually on the ground practical, how do we turn this into reality? Cecilia Kingsley is from the Riksbank. She is Deputy Vice Governor, I believe, who is one of the key people who launched Sweden's efforts to create an e-krona, digital currency, which in many ways has been at the forefront of central banks around the world. So I'm going to ask her a bit about that at the moment. John Taylor is a luminary of the world of monetary economics, former central banker, someone who is famous for the Taylor Rule, now a professor at Stanford University, who's seen how this plays out in terms of policy making. Michael Groniger is founder and CEO of Chain Analysis, which is a company which is trying to provide, as the name suggests, analysis of what's actually happening out in cyberspace, and really look at issues about due diligence, oversight, et cetera, et cetera. And he's also founder of Kraken, which is working in this field too. And last but not least, Chris Brummer, Professor Brummer, is a professor at Georgetown who has been looking at these issues from a regulatory perspective and also worked with a number of different regulatory bodies, be that the CFTC, FINRA, et cetera, et cetera. So we have an academic, if you like, or rather a regulator. We have a central banker come economist. We've got a tangible central banker today who's been at the forefront of this. And we have someone who's trying to build a business around this. Amazing combination. So perhaps I can start with you, Cecilia, and ask you, I mean, most people don't know quite what an innovative role Sweden has played in central banking over not just the years, but centuries. In many ways, you were at the forefront, the Riksbank, of many central banking ideas in the past. Tell us why you've created the e-krona and what exactly you see as the future of CBDCs from a central bank perspective.
Thank you, Gillian, and thank you for the kind words about my institution. I think, yes, we've been on the forefront, but for many reasons out of necessity. When society changed, central banks has to change with it. And we had still been offering sort of 20-kilo copper coins as our predecessor did about 350 years ago, I think we would have been out of business by now. So being there, providing service for people, providing a good version of money, stable store of value, of efficient medium of exchange is really left, right, and center for what a central bank is all about. But we looked at the situation sort of 6-7 years back, and we could see that the Swedes were rapidly abandoning cash and cash usage. And the technological possibilities has just made it possible to very happily live your life in Sweden without ever using notes and coins. And it wasn't perhaps so much of a dramatic change in most people's lives, but for society as a whole, it's kind of a new situation for two reasons. One is that we firmly believe that the integrity and the sort of trust in a monetary system, especially in the fiat monetary system, is the one-to-one parity between what we call commercial bank money and central bank money. That people know that you can always switch one for one, and you know, if you put $1 into the system somewhere, it will come out as $1 in the other end. So it wasn't crypto assets that forced us to look into this, or a financial inclusion problem, but more about how should the central bank continue to provide its service to society in a safe and efficient way. So integrity is one thing, but it was also that we were looking into a future where spontaneously the market for payment services would become privatized. And this is not a market just like any market. It's a high level of network effects, high economies of scales. And we didn't want to have a situation where the private sector sort of took over without actually having a conversation in society. How do we want monetary system and payment system to work in the future? So we started this, and a couple of lessons learned. One thing is we knew from the start that this was going to be complex. It's about technology, but it's also about policy and design choices. And it's also about rules, regulations, and supervision. And you really have to come back sort of like more than 100 years. It's as groundbreaking what we're trying to do now as our predecessors did around the turn of the century, 19th to the 20th century, when the note issuing monopoly was sort of settled and banks were allowed to become banks. And something, the last thing I'll say is that also a bit more surprising to me was there is quite a low level of understanding out there in society, and not only about sort of people in the street, but also among central bank pundits, and actually also on the academic side, and also within central banks. How does the monetary system work really? You know, nuts and bolts. What is the difference between central bank money, commercial bank money? And there's a huge difference between fiat money and crypto assets. So we are really doing an educational effort here across the globe, because this is changing for everybody, not only for Sweden. And the last thing I said about the e-krona is that, yeah, we're investigating this. We're into a pilot phase, but we still haven't made any decision whether to launch. And this is also a political decision to come in Sweden. I'll stop there. Thanks.
Well, that's fascinating. And I think the communication point that you highlight is very real. I mean, on that note, before I turn to, I'd like to ask John Turner next what his thoughts are. But before I turn to that, I mean, we got a very interesting question actually already from the audience, which I'd just like to bring in, which I think cuts to the core of a lot of what we've been talking about, which is how much of the foreseen transition to digital currencies is driven by a narrative. And I use that in the sense that Robert Schiller used the word narrative, and how that interacts with economics and finance. How much of it is driven by the narrative, hype, if you like, and how much is actually reflecting the actual promise? I mean, you are still testing out the e-krona, but do you actually need it? Is it just a bit of, is it just a great narrative?
Is that a question to me or to John?
It's a question to you, and I'd like to ask a question to John.
It's an excellent question. Do we really need it? I would say that if you want to maintain the integrity of the monetary system, protect people's trust in the sense that I just said, that you get one-to-one parity between central bank money and commercial bank money. You still want to provide that offer to society. Yes, then you need a central bank digital currency when the old technology, which I call notes and cash, are being phased into history. If you break that offer, you had basically created a privatized monetary system. You can still supervise it and you can regulate it, but there you get into a different problem, which is about the markets of payment services, which is not a very contestable market. There is a lot of economies of scale, network effects, and it's a classic area where the public sector finds it really difficult to maintain security, efficiency, inclusiveness, and things like that. So yeah, I think there is a need to maintain our role in history here into the future.
Right. Well, Professor Taylor, your name became stamped all over 20th century central banking and economics because of the contributions you made. As someone who, I say, became so famous within 20th century economics, how do you make sense of this 21st century innovation?
Well, I think, first of all, as far as book lists all the main issues. And so look at that and you'll get the main innovations that are occurring. I think the narrative is kind of how you interpret that. It's important, but I think there's so many facts here that we have to grapple with. And I think that's what I would emphasize. One thing that hasn't been mentioned is just that it's a cheaper way to make payments cross-border. As Glenn Hutchins was saying, it's incredibly expensive. And that, I think, is a real challenge, and we should get the price down. I think that Libra and DM are trying to do that as one contribution. And I say when we do that, let's not throw out what's working. I think the El Salvador experiment, maybe the dollar was just fine. And so let's stick with that. Don't just replace it because it's the dollar. I think regulation is very important, and there's a tendency for regulation, I'm sorry to say, to stifle innovation. It's sort of squashing out things from the private sector that may be there. I had an experience a number of years ago with a firm called Basis, but I think it was regulated out of business. So let's be careful about that. I'm not a great fan of negative interest rates. I hear what Eswar is saying in his book, and I heard some of the commentary already, but I think we need to be very careful with that. It's tried a little bit. It's not worked that well. The Fed hasn't gone in that direction yet so much. I think that globally, maybe more emphasis could be placed on that. I think that there's been a tendency for central banks to follow each other a little bit. That's, I think, because of the exchange rate issues. And so it could be with a new currency, a new ability to stabilize, that we would prevent that kind of contagion. And I think that would be beneficial. That's one of the problems with the current system. Maybe just mention one other thing. It's related to policy. So however we go, whether it's stablecoin, whether it's the kind of thing that Cecilia was indicating, I think some notion of what good central banking is important part of this discussion. I'd like rules, which is a way to think of that where the interest rate is set. There's other rules to have, but I think that's got to be a big part of this story. When you have one of these currencies that Eswar has described, other people have discussed, what is the mechanism to create stability? We don't want to have a global hyperinflation or something like that. We don't want to, the US, of course, has had some problems with inflation recently. But the notion that you have a process or a strategy for the central bank, and it could be more global, quite frankly, with the new currency coming into play. But I think there's great opportunities, and a lot of it has with cross-border payments, possibility of greater stability, possibility of less contagion of policy across borders. And we should strive for those and don't regulate it out. Look for new ideas. Some of them are coming from the private sector. And I think that's the way to go. Anyway, thank you.
Well, I must say, I spent quite a bit of time digging into this recently for a number of pieces and talking to people in Singapore. For some reason, the most innovative countries in this area all begin with the letter S. Sweden, Singapore, South Africa, places like that. But Singapore, the regulators there are quite upfront that actually one of the main impacts of this whole blockchain revolution may actually end up being to make the existing payment systems, which have been very flabby and not subject to proper competition in the past, to force them to suddenly become more competitive and offer better solutions without crypto. So that's an interesting point to discuss. I'd love to ask what you think. But Chris, John's pointed out the importance of regulation and regulators. The US right now is in a complete mess. Because, to take Bitcoin, if you think Bitcoin's a currency, it probably ought to be the Fed that looks at it. If you think that it's a security, it ought to be the SEC. If you think it's a commodity, it probably ought to be the CFTC. What is it? And no one really regulates it right now, as Chairman Gensler's pointed out a few times. Does this concern you?
So, well, those are really hard and interesting questions. I would say, just starting backwards, it's not that nobody regulates crypto assets or in the United States. We do have rules, and we have different kinds of rules depending on the facts and circumstances of different kinds of transactions. Now, as one of the challenges for the regulators will be trying to think through what crypto assets mean in the context of our existing legacy regulatory infrastructure. And there's a lot of reasons why you can say, that work has a long way to go, right? And let me just sort of have a running start by just trying to connect the dots a little bit for many people who are probably thinking about this from a banking sort of regulatory perspective, and what it really means when you talk about regulation from, let's say, a market regulatory perspective, because it's a bit different, right? So I think one of the challenges when you think through what does it mean to have a blockchain-based digital currency or virtual currency is that, when you think about the traditional use cases of money, ultimately what you're seeing now is that this new technology is expanding the possible use cases. And this is something that Eswar pointed out initially in his initial remarks, right? So in addition to thinking about it as a store of value and medium of exchange and unit account, I mean, ultimately now we have this idea that money itself can operate as code, as in particular, a kind of code that can be designed to execute and operate, according to pre-established technical parameters. You have this idea of money as an infrastructure, more importantly, a digital infrastructure. So where you can have contingent value transfer relationships on top of which other kinds of relationships can be built. So money as a platform, right? And then, social or closely related, you have this idea that money can be a commercial or even social ecosystem. And this is something that was also brought up in the previous panel. Now, why this is important from a market regulatory posture is that when you start to get into issues like digital infrastructure, it touches on questions relating to securities law. It touches on issues relating to AML KYC. It starts to touch on issues possibly relating to, again, depending on what kind of infrastructure is being built, derivatives law, right? And these, the way in which regulation operates, the kinds of requirements that are applied differ according to what part of the financial system that infrastructure could be touching, right? And so, for obvious reasons, many times the banking regulators are looking at certain kinds of infrastructure, and their macroeconomists are thinking about the operation of monetary policy, but the market regulators are looking at what's actually being built, right? And how and the degree to which what is being built is fitting into, again, this pre-existing legacy regulatory architecture. Now, for the market regulators in the United States, many of those rules were built in the New Deal, or right after, basically in the 1930s, right, which did not anticipate anything that we're seeing today, right? And so, there's a quiet debate going on as to how do you map that onto what we're seeing today, and that conversation in itself. And it's, here the details kind of matter. There's a bifurcation, and a lot of times we use the word regulators, but I think what we also heard from Cecilia, you hear it popping up. There's a difference between whether or not you're talking about a banking regulator, a market regulator, and then whether or not you're frankly talking about politically elected officials, and what are the interests and the levels of expertise coming out of in the United States, out of Congress. And those things really do matter. What we've seen thus far is that there are instances where crypto assets do pretty firmly implicate existing rules and laws. It's not necessarily put together in a very clear and clean way. And for that reason, you're seeing a lot of people in Congress putting forward just this week, a number of attempts to streamline and to make clearer the tools that are available. Clearly, just coming from some of the regulatory actions coming out of the SEC, it's not as if the SEC has, lacks tools. I mean, the SEC does have tools, but the way in which they're used could be viewed as either novel or unconventional, or as second best, given the specific technology that we're talking about. I would say, just as a excuse me for waxing too philosophically as a law professor, but I think that one of the challenges that the regulatory community is going to face, even if they think through, okay, we have certain kinds of objectives that we have under our mandate, how do we fulfill those objectives based off of the tools that we have? I mean, I think clearly one of the challenges is going to be consistency, in terms of how you apply those tools, predictability. These are actually sort of, frankly, from an international standpoint, sort of general principles of law. And there's what you're hearing from people, perhaps not using that terminology, are questions arising as to whether or not those principles are having the same priority in the application of the tools that are available when you are going through and examining that technology.
Well, that's a very real issue, because obviously what happened with the SEC last week, indicating that it was clamping down on lending within the DeFi space in a way that many people find quite, mystifying. They can't quite see the reasoning. It's caused outrage in part of the DeFi community, is very striking. And again, to go back to Singapore, I was very struck that when I did a lot of speaking recently to people in Singapore about why they're leaping ahead, the countries with S's, one reason is that the Singaporean regulatory system is basically one body, one institution that can move very fast in tandem with the private sector to a degree that would be unimaginable in the US today. Which brings me into hearing what Michael Groninger's got to say, because you are actually trying to turn these ideas into a tangible business plan. You have worked pretty hard to try and keep the regulators on board, from what I can see, and yet, as I understand it, even you are facing challenges in trying to work out what on earth is happening. And having spoken to a lot of people in the private sector in the last few months, I get this constant eye roll of, well, you just do not understand, and you means journalists as well. So tell us what we're getting wrong in your views, and by us, I mean both the academics, regulators, and central bankers.
Yeah, I think these are really good questions, and I would say that maybe we should rewind everything 10 years ago and think about the early days of crypto and the early days of Bitcoin. In those days, the perception of Bitcoin was like, this is anonymous money, and that was the value proposition. So the fact is actually the exact opposite. That this is like the most transparent financial system that ever been created. Every single transaction is public. It's hard to analyze, but when you actually analyze it, it's out there. It's similar to the early days of the internet, and I'm not talking about the 90s, but the 70s. The internet is really old. There was no DNS, there was no names. There was just like numbers that you would contact if you wanted to get anywhere. So that meant it was, for all practical purposes, anonymous and useless. But then later on came a DNS, so you can actually write www.ft.com, or we can do other things, and then we can also search it on Google. So suddenly it had utility, and it was not anonymous anymore, and we could use it in various different ways. The same thing is happening in crypto. So this is like the evolution that we're seeing. Another thing that we are seeing in the crypto space is that in the early days of crypto, the perception were like, I cannot send a Bitcoin because I might be implicated in the bad uses of Bitcoin when I do so. Now we understand that if I send a Bitcoin to Chris, first of all, he becomes happy. That's one thing. But the second part is that I'm actually not implicated in any other transactions in the crypto network, even though it's being used for bad purposes at the same time. And I should add to that one that the bad purposes in crypto is less than 1% of the transaction volume, so it's really minute here. But then when you then look at DeFi, and now we get into the next phase, like this is very different, and some of the wording is confusing as well. So some of the words around DeFi is like it's a decentralized exchange. Oh, it means that there'll have to be KYC and have to do other things. The fact is that the technology actually facilitates via liquidity pool the ability to go from one types of asset to another. It could be from euros to dollars, it could be Bitcoin to Ethereum, it could be from different tokens. And that is basically, again, completely transparent. So we are certainly looking at how should we regulate. So all the laws of regulation have been written in a time where it was a completely opaque financial system. The only one who knew how I used my money was my bank. And that means the bank had a reporting requirement. But those who know those who can have oversight over DeFi are actually everyone. So it means that the regulators have full visibility into the usage of DeFi, to the problems of DeFi, to who might use it and who might misuse it. And it means that you actually don't have the same need for regulation simply because it's so transparent. So it is changing how we should think about regulation. And I would also stress here that it is important to not necessarily just apply the old rules on a new technology. I would agree with Chris that sometimes it does actually make sense to apply the old rules because it is what it is and it is the transaction, and sometimes that's the case. But in other situations, we have to move back and say, why did we put the regulations in place in the first place? What is it solving? And all the things regulations solve for, I think the entire industry can subscribe to. It's good. It's about protecting citizens, and we want that.
But I mean, just leaving aside the fact that obviously private chains can't be scrutinized by everybody. You know, public chains can, but private chains can't. But you know, that's a separate issue. But you know, how do you? I mean, I understand that you've developed tools to try and track Bitcoin transactions for law enforcement purposes, and you're trying to take the fact you do, at least for the public chains, have a record of what's happened that could enable you to identify who's behind transactions. How are you actually doing that in practice? Do you think that your ability to use that transparency to trace dirty money will actually in any way change the public narrative or the political perception of Bitcoin and other aspects of this world?
I think it very much has already. So when I talk to our prime customers, so we have customers from the public sector in more than 30 countries in the world. And all of, for example, law enforcement agents, they would attest to, and they would do so like since 2015 when we launched our first product, they would attest to that it's actually easier to follow the flow of funds in the crypto economy than it is in any other. If you want to follow the flow of funds between bank accounts, you need to send subpoenas to banks. You need to go through the MLAT system abroad. So it takes months to years to actually follow a transaction. In the crypto ecosystem, it's very simple. You can immediately follow the flow of funds, and they learned that. And they have constantly been telling regulators that this is actually easier to make enforcement actions in this financial system than in the one that they came from. So I would say that that's actually working pretty well. I still think that like every time there's a new word that appears like the NFTs or DeFi, then we have a new like level of education that we need to go through before everyone will be able to be on board with that. And in that process, there's also always a risk of misunderstandings and potentially bad regulatory actions that could happen.
Right. I must say, I think the fact that DAO hack failed in 2016, and the fact that the hack failed in August of the platform with Ether, I think was quite striking. But Chris, would you agree that in fact there's more transparency, not less, in this world?
Well, certainly, and this is something that's why I'd pointed out as well. I mean, when you move things to a digital world, you start to leave your an imprint, and it makes it much easier to work backwards. And I think there was this massive misunderstanding at first. I would say that, and this is just to emphasize just how difficult this job really is for regulating the space. I mean, even within the industry, right? Many of the terms that are used are terms of art. right? And even within industry, sort of people can, I mean, literally, when you talk about like, well, what is a blockchain? I mean, sometimes people will have their own perception as to what is a blockchain, what is decentralized, what does that mean? And even within the industry, in terms of sort of figuring out, well, when is something decentralized, people can have their own difference of opinion. Now, obviously, when you want to move those slogans or terms of art or ways of doing business to a regulatory font, that's even more challenging, right? Because now you're trying to define with real precision and with real consequences what those terms mean from a regulatory perspective. But I do want to, co-sign, this idea that, look, I mean, when the regulators work, theoretically, the idea should be to say to themselves, and I'll just use the idea of, since you brought up the SEC, when we talk about what is an investment contract, one of the things I always try to share with both industry and my own students is that Howey test, it's not like someone just decided to say to themselves, hey, I'll just come up with these interesting standards, right? I mean, it's because each of those line items, an investment of money and a common enterprise with the executive, they're trying to highlight certain kinds of risks, right? So if you're putting your own money at stake, maybe you're really excited or you're really fearful. If someone else solely has discretion over how something works, that means you have a lack of control. If you're in it with a whole lot of other people, there may be, decision-making problems or incentives that arise that maybe, you may be depending too much on other people. So in other words, the SEC is saying, when you have all of these things together, we are going to step in and require registration and all this other kind of stuff. However, when you have technology, it does change for the better and for the worse in different ways, risk profiles, right? And how you think about risk and the degree to which anyone is empowered or not, right? And if you're not being serious about thinking through what that technology means, you could come up with a suboptimal outcome. And I think that's why, my original remarks about general principles are really kind of important, in terms of with a nascent technology. If you want to have any hopes at getting something that's going to be effective and right and
right,
good and acceptable for both industry as well as the end user. And that's what this ultimately comes down to.
Well, before I turn back to the central banking aspect, I'd really like to go back to Michael and ask you, Michael, which regulator do you think gets it best? Because you're dealing with regulators around the world.
Yeah, it's hard. I'm like picking between, and all of them, like a lot of them are customers of ours, of course. I would say the people at
what
Treasury,
part of the world? What part of the world?
Yeah, and what part of the world? I actually think that the level of education amongst many people in Treasury is really, really high. It is really good. FinCEN Treasury gets it, understands it really well. I would say that they're probably the one that I would rank highly there, as being really thoughtful, understand how it works. And the interesting thing is, if you build laws and if you build regulation, there are a lot of people that are helpful, like all the civil servants that are part of this. They have an extremely good understanding of the crypto ecosystem here. And they're also the ones that have been listening to agencies, like other government agencies, to law enforcement, and hearing their stories and really understand it well. So I would say they're probably some of the ones that I would highlight here.
Right, that's suitably tactful. Shows why you have survived and stayed out of the headlines so far. But let me turn to the central bank side of things. And I mean, I'd like to ask, there's a question from the audience, maybe either for you, Cecilia, but also, again, John as well. What can you do with the CBDC, which you can't do with the current digital payment method? It comes back to the point that, the Singaporeans keep making to me, that actually the end result of all of this might be to make the existing legacy systems a lot more efficient because of competition. But, what is a point of a CBDC as opposed to other things? I mean, I think John has got strong views on this, but let's hear from you first, Cecilia, and then John.
Well, I'd take you back then to the 19th century when the American, you had the so-called wildcat banking system where private banks were issuing notes. And for those who liked that system, were happy enough to hold notes from a bank of a good reputation, that question would have been the same. Why would I need dollars issued from a Federal Reserve Bank. What's the point? I'm pretty happy as it is. Well, you come to times in history where the public sector has to put its foot down and be clear about the structures and coordinate interests in a way that makes the system work for everybody. And I think the person who might have asked that question is financially included, knows how to move around. But if you look at US data, I can see that a number of people, and a growing number of people, are actually financially excluded. And John's comment about how cross-border payments in the world works is I agree with that. That is a poor system, and I think both the private sector and the public sector have failed there. But it points to me that it tells me that about 1.5 billion people in the world does not have sufficient access to financial services. And as we now go into a digital society, I think we have to make sure that everybody gets decent access to be able to make payments in a safe and efficient and effective way. It doesn't mean that central banks should try to be particularly innovative. I agree with Glenn Hutchins' point in the previous panel that that's not our best side, but by providing an infrastructure that supports resilience, inclusiveness, and competition, I think we could be able to sort of pull the monetary system into a much brighter future. If you're happy with the current system, you're probably happy with your bank. You don't have to do a thing. You can just sit still. It's not for those persons in the society we're working.
Which, of course, is one reason why the emerging markets right now are, potentially going to leapfrog. And we'll see what happened with M-Pesa play out several times over with CBDCs and stuff like that. Chris has made a great point. I was going to read out before I turn to John, which is that MiCA, which is, for those of you who don't know, it's the European Commission's new proposed regulatory framework for markets and crypto assets, MiCA. He points out that they are also doing some very interesting work in terms of looking particularly at stablecoins. And I know that this is a Washington-based panel, or Washington Brookings institution, but it's worth looking across the Atlantic to see what's happening there. And by the way, I should stress, it's worth everyone who's interested in this looking very hard at what's happening in Asia right now, not just China, but Hong Kong and Singapore are fascinating. John, do you see any point in having a CBDC? Is it just all a sort of, could we just do this with better digital payment systems across borders instead?
No, there's huge improvements that can be made. So you mentioned the cross-border costs are going up. Glenn mentioned the statistics. That's a real problem. And we tried to work on that 20 years ago with various mechanisms to improve the payments, but we haven't got there. And I would say that's one of the focuses. How can we make the world a better place with this new technology? And we can. The dangers that people are mentioning, one is overregulation, but I think you still have to worry about the basic rules for monetary policy. Let's not forget, it's an increase in money.
Taylor rule, amongst others, yes.
Whatever. I just think that some focus on that. And what are the Chinese trying to do? Are they trying to replace the dollar? And just a little of a global aspect. And I think it's a real issue. You're mentioning Asia is important, but here, you have to think what is going to replace central bank policy? Because it's a new currency, it's a new method. What is there rules, interest rate rules? I mean, I'm talking about macro rules, not micro rules.
Well, I think that's.
Sorry.
I was going to say, I think that's something which has barely been discussed yet in terms of what this means for, the future of, never mind private money, but central bank money, and how central banks in the future will or will not run their policies. We are going to get, at the end of this month, hopefully, a report from the Boston Fed about the experiment that the MIT group have been doing to try and build a digital dollar. They're using a proprietary technique, not taking sort of platforms that other people have used to date, like Ethereum and others. And it's going to be very interesting to see what comes out at the end of the month from the Boston Fed in that respect. So before I hand back to Esma, I'd like to quickly ask everyone to quickly give me a number, which is, if you look forward 5 years, what probability do you assign to having a CBDC in the US? I'd like to ask you all, because our numbers are great in terms of crystallizing odds. Maybe I could be fair to Cecilia and ask her what probability in Sweden. But for the rest of us, like John and Chris and Michael, curious to know what you think the probability odds are of actually having a digital currency, a CBDC in the US in 5 years' time. Maybe I can ask you, John, first, since you are somebody who's been in the center of this for such a long time.
So I think we had a discussion of definition here a bit. I think to some extent, if you have something which is stable relative to the dollar, I think it could occur pretty soon. How much are we using currency right now? I haven't used a dollar bill in a long time, for example. So I think that's happening as we speak, and I think the Fed is probably a little cautious, extra cautious, but I think 5 years is a good guess as any.
So kind of wholesale CBDC rather than retail in a way. What do you think, Chris?
Yeah, definitions are important. So I guess we're talking about like a token, because the Fed would probably say we already have one. We do have a digital dollar. If we're talking about a sort of a tokenized digital dollar, 5 was a guess as good as any. I think can I just sort of say that I think the conversation, because there is a policy conversation behind that question here in the United States. What good is it? What will it do? Up to this point in time, it's been a macroeconomic monetary conversation, but I do think that one of the things that will seep into the conversation, both for the CBDC and even when you get into the cryptocurrency issue, that's really been not fleshed out, is this question of financial inclusion. Wealth inequality in this country, particularly racial wealth inequality, is a big deal. It is one with political salience. And so one of the questions, and I'm sure one of the policy concerns, will ultimately be, not just when you think about the still considerably large size of numbers of unbanked people in the United States, but also the question of the underbanked and badly banked people who tend to be more to have much more modest means. What does an additional or a new rail, either both in terms of payments and frankly, if you're talking about a tokenized infrastructure where you can build new kinds of applications on top of it, what does that mean with a government more and with the Federal Reserve, more honed in on, focusing on the question of financial inclusion. And I think we'll hear more about that, I think, as the conversation matures.
Definitely. Michael.
Yes. Okay. So I would actually say that we already have one. So we have one for practical purposes. That's fine. We have Tether. We have like USDC. We have a lot of stable coins out there. They're pegged to the dollar. They can move across any border. So the problem is solved. It's there. It's privatized, which is probably great, and it's in competition because there are multiple. So we already have one. The question, if you rephrase the question and say it should be state issued, then I think the chances are close to 0.
Nice provocative point. Cecilia, as someone who's actually in a central bank trying to work on this, what odds would you give for both Sweden and the US? You can give
if I sort of frame it down to a retail CBDC, so people can have access to that. The probability for Sweden in 5 years, we have already sort of outlined all the work that needs to be done, and it's also dependent on legislation. So within 5 years, I would say the probability is low. I'm not going to give you a number, but it's low. But if you expand the horizon going 5 or 10 or 15 years out, I think globally we will have a future where several countries have CBDCs for different reasons, but mainly to maintain the integrity of the fiat money system, efficiency, and in terms of financial inclusion and effective payment services. But I also expect that we will have a couple of well-designed stable coins, which can actually be seen as a sort of private version of a CBDC. And I think most of the crypto assets that we see floating around now, I think it's about sort of 7,000 or 8,000. They will be gone, and there will be a lot of people that has been subject to quite a lot of nose bleeding as they went.
Well, Cecilia, that was a very powerful, punchy note on which to end. And I think it sums up the sort of overarching message of the debate, which is that there is real movement happening right now, much faster than many people recognize or expect. And it's partly the understanding is low in the public's wider public because of the technical complications. The developments won't be quite in the way that the evangelists expect or hope. They're likely to be very uneven and complex. There will be big winners and losers. But I guess the one big takeaway from all this is we need a lot more information and understanding, both amongst practitioners, but also in the public sector, regulators and investors, which is one reason why Eswar's book is so incredibly timely, not least because it simply explains what's going on and what we need to know about this. So I'm going to hand back to Eswar at the end of this, say thank you, a very big thank you to our panelists for a very provocative discussion, and hand back to Eswar for a few closing thoughts to finish off what's been a really fascinating hour and a half long discussion. So thank you. Eswar, the floor is yours.
Thank you, Gillian. Wow, that was a panel with a tremendous amount of policy, research, and academic expertise, and I'm very grateful for all those perspectives. So what I will try to do is just summarize what I see as three of the main themes that came out from this discussion, and I'm of course seeing them through the lens of my book. The first theme is that we are at the cusp of a technological revolution in finance, and financial innovation, of course, is not a new thing, but I think the new technologies that have been spawned by Bitcoin, that are underpinned by blockchain, really hold out a tremendous amount of promise. We are going to see significant improvements in payment systems as they turn digital, and these benefits are going to accrue across the board to consumers and businesses in the form of cheaper and more efficient digital payments within borders, across borders, economic migrants sending remittances back to their home countries, exporters and importers using the international payment system are all going to face much fewer impediments. And I think this is good for global trade, for global finance, and ultimately is going to be helpful in terms of economic welfare. And in addition, I think what Bitcoin has done is also lit a fire under central bankers, which, as some of the panelists have indicated, might sometimes be somewhat slow to move and reactionary. But I think we are seeing central banks beginning to get into the game by realizing that to remain relevant, at least in terms of their retail money, they do need to act, and many of them, as is the case of the Riksbank, are indeed acting. The second issue is that I think despite all these technological revolutions, there is still going to be a very important role that central banks play and policy overall plays. And ultimately, there is no good substitute for, as John pointed out and as Cecilia alluded to, a rules-based institutional infrastructure that can support all of these developments and make sure we can generate all the benefits that it can deliver while managing many of these risks. And that's going to require, a lot of nimbleness on the part of regulators. And I think both Chris and Michael and also Glenn have pointed out that you could have an overbearing government that ends up stifling innovation, which I think is not what anybody, including visionary central bankers and government officials want. But we will need oversight of what is blooming, and it's going to be very difficult, I think, for this system to really thrive without the bedrock of the sort of trust that government institutions and the protection of contractual and property rights, which only a government can enforce. I think those are going to be essential. And the third and final issue is that I think we have to keep in mind that technology is not going to solve all problems. Certainly the flow of information is going to be much greater, but this could end up becoming a cascade of information that becomes very difficult to filter through and for people to process. So you might have in financial markets, bandwagon effects, cascading effects, basically leading people to follow the herd and creating even more instability. While the radical transparency of Bitcoin and blockchain technology more broadly is going to be very helpful. I think the ability to filter information is still going to be really crucial. So some institutions will certainly continue to play a very important role. And equally, I think governments will have a role to play in making sure that certain elements that, as Chris pointed out, still foment inequality don't end up leading the new technologies to making things worse. Right now, digital access, financial literacy are all very unevenly distributed across populations within countries and across countries. So I think governments have a real role to play in making sure that these underlying problems don't get magnified by the new technologies. And also the new technologies cannot be counted on to fix all problems. I mean, network effects, for instance, could come back to bite with a vengeance, even in payment systems. As Cecilia pointed out, payment systems are not entirely contestable. There are network effects, and I think it will be important for some degree of regulation to make sure there is a level playing field. And there are templates that are developing very quickly. India's unified payments interface, for instance, is showing how you can bring a lot of people into the financial system, manage problems like know your customer requirements, while at the same time giving a large part of the population access to digital payments as well as a portal to basic banking products and services. So I think there is a prospect of a much brighter future, but it's going to take a lot of work on the part of all of us, not just financial market participants, but governments and citizens around the world. Because ultimately, again, to echo Cecilia's words, this is not just about technocratic issues or about economists determining things. Ultimately, a lot of these things have to be debated, discussed, and decided at the societal level. So once again, thank you very much to all of you for participating in this event and for being at my book launch, and to David Wessel and the Brookings Hutchins Center for organizing this.